Splashcreen. Wake up, motherfucker.
All right, what's up, guys? Oh, we're gonna crash. I don't know if we're gonna crash. We're gonna have to wait for tomorrow, and then we have to wait for Friday. Options expiration. I don't know. Whatever. To me, it's like wait and see. We gotta get up to Nvidia earnings on Wednesday. How about that? Let's wait for that one. That's the big kahuna. All right, that's the big kahuna right here because I really don't think any of this Trump stuff or Iran really matters. Nothing has changed. All right, whenever we started the war and all of that, it's like yeah, diesel prices are going up. Yeah, oh wow. And then like so this morning I was showing all those graphs, everything. It's like what really changed? Did anything change? I don't think so. I think the only thing that changed is the fact that we will have VIX expiration tomorrow. Okay, so in the morning they will give cash prizes to whoever guessed the correct price for the VIX futures. And then after that, we have to wait for Friday expiration. And there's no big earnings really this week unless like Walmart earnings is a big deal. I mean, Walmart is a big deal. Yeah, sure. But is it that big of a deal? I don't know. I really don't know because the Nasdaq really runs things. So technology stocks really runs things. And we don't really have any technology stocks out of like maybe there's only one of them, right? That's reporting today. I mean, tomorrow after the close. Let me see. Which one was it again? It was one of those semiconductor stocks. Let me see. Hold up. So we covered that a little bit in the morning. So I'm kind of more interested in the Chinese stocks. I want to see what Alibaba does and all the other little ones. See what happens because Chinese stocks are probably going to be very tradable, very tradable. But outside of that, nothing much. So let's see. All right, let's see. Yeah, analog devices. That's it. Analog devices. Who cares? Honestly, that's not a big deal. That's not a big semiconductor company that's gonna really change things. So, so outside of Walmart, Target, TJ Maxx, Lowe's, we already had Home Depot. Home Depot didn't really do anything. If you care about makeup, Estee Lauder. Okay, Estee Lauder will report tomorrow in the morning. So Target, TJ Maxx, Lowe's, Analog Devices, Estee Lauder. And we have some Chinese stocks, Weibo, Full Truck Alliance, YMM. Yeah, Full Truck Alliance is pretty cool. Maybe that might be interesting. Outside of that, nothing much. So, dude, none of the earnings is really going to affect things. When the hell did they officially start 24-hour trading? I knew you would put in orders overnight, but when did they start filling outside market? I heard like they were testing some some trading outside market hours. I haven't been paying attention. I did see some tweets saying they're gonna start doing I mean they slowly roll out different phases, right? They have a phase one, phase two, phase three. So yeah, I'm not completely sure. You can check on Twitter. Usually Twitter has something. I did see a tweet talking something about that. They're gonna try some things. But anyway, we're on the road to 24-hour trading. I don't think we're fully there yet. So I don't know. I don't know. Let's see. Let us see here. Blah, blah, blah. 24/7 markets aren't some distant thought experiment anymore. Regulators are now discussing the infrastructure required to make always on markets actually work. Continuous clearing. Yeah, you need that. Real time collateral, surveillance, and risk management. The CFTC, so the futures commission, okay, for the government will meet again Thursday. If this direction continues, the implications go far beyond longer trading. So, all right, that's probably not it. But let me see. Let me see if there's anything else. 24-hour trading is a horrible idea. All right, thanks. Good job. Yeah, I'm trying to look for it. Let's see. I hate 24-hour trading because of this type of shit. Nasdaq, we need 24-hour trading. I mean, I did see something, but I'm not 100% sure what exactly they said. Okay, let me check my bookmarks. 24-hour. Oh boy. Now I got to figure this out. Let's see. NASDAQ is introducing a new trading session from 9 p.m. to 4 a.m. Eastern starting December 6th. The stock market will soon trade 23 hours a day, 5 days a week. Right. NASDAQ global trading hours. So this is with the NASDAQ. That's what I thought. But it looks like it's not here yet. We're going to have to wait for December. Interesting. Yeah. Okay. So yeah, we're not there yet. I'm not sure what's going on right now, but I knew you could put orders in overnight. But when did they start filling them outside market? I don't know. I don't know what broker you're using. Um, I mean, some brokers already do overnight trading, right? The big ones are Robinhood and Interactive Brokers and probably some others, right? Interactive Brokers and Robinhood, I know, are like the ones that do them the most because they offer the most tickers to do overnight trading. But official overnight trading doesn't look like it's going to happen anytime soon. So the Nasdaq might start doing it in December. It looks like. All right. So there you are. We don't have anything yet. That's what I see right now. All right, let's continue on. Yada, yada, yada. Let's go this one. Okay, NBIS. So last week you had earnings on NBIS. Very good, right? And I think from a technical perspective, it's pretty easy. You see this MACD going up here. Very nice. You get the pinch. You go up, and then you have earnings continue on up. But it looks like we get stuck again, right? You got VIX expiration, you got options expiration. Obviously, this level is going to be hard. So NBIS right now is the top performing neo cloud, AI, data center, blah 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 infrastructure one we had. And we had some earnings for some of them, right? HUT, CIFR, but both of those earnings for HUT and CIFR did not materialize in any push up here. So you see the earnings came out. It wasn't as good as expected. It melted down. And now we're back at this orange dotted line. So I'm looking at these type of stocks and going like, okay, should I buy again? Is this where I want to buy again? Is this how we should be looking at? CIFR, same thing. You see this? We dance around the range, and then we after earnings it starts going down. Okay, so a few stocks in this area actually went up. NBIS is one of them, and NBIS actually got added to the Nasdaq 100, right? Core Weave was another one. Core Weave was added to the Nasdaq 100. It had earnings. We went up. Okay, but as you can see here, this one, it got up to the old range and then it failed. So you can see like, okay, this was the old range. You go back up to the original old range and now you're pulling back down. So none of these look particularly enticing to me at this point. I would love to believe in them, but right now, no. Because like these companies, they're kind of halfway between the semiconductor side and the software side. So I can't tell if these guys want to go up regardless of the semiconductor weakness right now. And then it tries to catch up with the software strength. It doesn't look like that's happening. So this thing is kind of middle ground between, oh, should I be more of the software or should I be more semiconductors, right? Which one do I follow? Because these are kind of like in between. These guys are like in between those two sides of the AI ecosystem. So it's hard to tell. But guess what? Look at Adobe today. What did Adobe do today? Well, it didn't go down with the market. It was actually up 3.58%. What's the other one? Intuit. Um, Intuit was up 4.4%. So I could see that some of these software companies are helping out. Okay. That's why I think like next year is going to be a software year. Semiconductors was last year into this year. That's probably over. And I don't know if like Hut and all those other guys, which one would they follow? Are they going to follow semiconductors or are they going to follow software? I still can't tell. I still can't tell. I think right now it looks kind of iffy because after the close today, we saw this news affecting which one? Which one of it? Wi-Fi. So Wi-Fi had a good earnings. So it kind of went up a little bit, right? 18%, but not really making a new high. All right. And then we got news after the close. It's down 18% overnight right now because they issued new shares. They issued new bonds. They are taking more debt and the market doesn't like that. So let's look at the news right here. Wi-Fi, white fiber. $250 million in debt offering. Oh, yeah, you have good earnings and now you issue more debt. Shares of White Fiber slid after the company disclosed plans to sell $250 million in debt to buy back existing securities and pay for its data center build out. So, yeah, not all these companies are going to work out, right? These guys, that's why these guys are crap companies. Um, it's hard to tell which one of these actually will make it. So Shaz is another one. So White Fiber, Shaz, these guys are new. Like they IPO'd pretty recently. Shaz 2026, White Fiber 2025 in August. So both of these are new boys. And I don't know. It's kind of hard for me to tell. Is this going to continue on up? Yeah, it's easy to go up from March. All right. White fiber. How about this? Yeah, yeah, it's easy to go up from March, right? It's easy to go up from March. But look at what happened last year, right? You go from August, you go up, you go down, you don't know. So yeah, I have a hard time really thinking like these guys will make it into next year anymore. Like it has to really prove themselves, right? They have to really prove themselves. We'll have to see in October probably if these things will make it. It's tough to say. But that's why I was like, yeah, I think it's time to go to software, you know? And today, two of the crappiest software companies, at least in performance, Adobe, Intuit, were actually green today. So that tells me a lot. That tells me a lot for sure that I'm probably right that we are going into a software dominant market going into next year. So I don't want to mess around with semiconductors. I don't want to mess around with anything that used to be winners, but they're no longer the winners, right? And yeah, it looks like it. It looks like software is going to take over. All right. So, yeah, so yesterday I talked with some of these already, right? I went over a lot of them. So today we're going to do some biotech. All right. So Schrodinger, this one does AI drug development. Bill Gates used to own this through his Gates Foundation. I don't know if he still has shares. I'm not sure. I think he probably sold everything because it just kept going down. You could see like at the peak here, 2023, and the higher peak in 2021, he probably got out. And we hit a bottom this year at about $11. Okay. And now we're recovering. So I'm starting to look at this one again. I'm thinking like, okay, AI, drug development. AI and drug development. So let's look at stocks that have this type of market. So Schrodinger SDGR, maybe this one is going to make it. All right, so let's look at the weekly. All right, you make a new bottom here. Okay, I'm interested. This might be it, right? Look at the weekly. Look at this. Moving average. It's changing. We tested it. All right. So we got the 18 starting to cross over the 40. We're testing it on the weekly. We have this like little kiss here, the duckbill shape um, that Joe Rabel loves. And we have the ADX moving up, the green DI moving up. Hey, the GDSDGR looks pretty good to me. Okay, let's look at another one. How about this one? ABSI. All right. So this one opened out in 2021. Okay, so this is fairly new, and we see like this level here tested right here at 2022. It failed, it went down below it, tested it from below 2024, 2025. We could also say it really tested it in August of 2022, and now we broke out of it. So this one looks interesting as well. So if we believe healthcare is going to be a winner next year, yeah. And then this thing also has AI. Perfect. So you got AI and your healthcare. Yep. I'm probably going to be interested. How about this one? Relay Therapeutics. Okay. So this one has that kind of like straight down, straight up type of maneuver, which is not common in stocks. All right. So you kind of go like straight down, straight up. So yeah, this is not common. Usually stocks do not do this. They make a range for a while and then they move back up. But this one goes straight down to the bottom, nearly penny stock levels at $2. And then from $2 it's going up to $20. All right. All right. So this one looks interesting. And if healthcare continues on, sure, maybe this will do well. Another one that acted like this, WGS. You see this? Straight down, straight up. We talked about this. And then it made a range here from 2024. We started going up and down around this $77 level, which is like apparently very important because $77 was the last like kind of high in 2022 before it fell. And so we've been dancing for a couple years around it. And I saw this because I was waiting for it to make a new low. And I'm like, oh, okay, look at that. This earnings, we went down a lot of volume. And then after that, we just melted back up. And then we just had earnings recently. And it's like, oh, okay. I like this. I like this. Maybe it's gonna try to break out and get above 77. And next year we are going to fly higher. So yes, these four stocks: AI, drug development, SDGR, Schrodinger, Absci Corporation. I don't know how you pronounce that. ABSI, Relay Therapeutics, RLAY, and GeneDx WGS. So these four maybe are going to help you get big gains. These things crash very, very fast. But if they crash very fast, they also go up very fast at the same token. So if we have a bubble, if people like AI, but they also like healthcare and drugs and pharmaceuticals, then yeah, these four are probably going to be winners next year. So I will be looking for next year these four. All right. Okay, let's look at energy drinks. Celsius. This one used to be popular. I used to be in it, and then I got out, and it's like it's been doing this ugly. Like I can't even say this is going sideways. I don't know what this is. This is terrible. This is not really sideways. This is very volatile. But I bring this up because if you look at earnings over here, back in 2025, we had this motion. Okay, so let's look carefully at this. You see this? This thing went below $26. This cyan line, I guess, is very important. I just drew it over there. And we went down, we went up, we went down, we went up. So, yes, very important. And it drifted higher, okay, because like April was the tariff stuff. We drifted higher with the market. And then we had this earnings over here in October 2025. We failed, we went back down, and now we are dancing right back there. So we recently had earnings. We recently had earnings. So let's look at this, right? Look at this. Look at this. You go lower, you go back up. The next week, you go down, you go back up. This week, we're at the back of the top that it made 2 weeks ago when it had earnings. So it looks like it's defending $26. It's defending. We got this huge amount of volume, and we haven't gone lower yet. So I'm guessing people want to keep this at $26 at the very least. So perhaps this is where you're going to look for um, the bottom of a range. So if this is the bottom of a range, eventually, I don't know if it's going to be next year, this thing is going to go up. So, and Red Bull is getting expensive, right? And I don't know about Monster energy drinks. So I can look at Monster and see what it's doing. Monster is like this right now. Okay, this doesn't look very good. This looks like it's about to crash. So maybe the competition from Celsius is winning. Maybe this thing is going to make it. And energy drinks are lucrative because it's high margin. You can charge a lot of money for stupid sugar water. Okay? So they can charge you a lot, make a big profit. Their margins are high. And yeah, people love being addicted to this shit. So there you go. So yes, energy drinks are good. Red Bull doesn't have like a stock. It's not a public company. So if you're going to ask me if Red Bull has a stock, it doesn't. It's a private company. Ah. All right. Man. Oh, that's going to change the dynamic. Yes, it's going to change the dynamic. I know 24-hour trading. Yes. Yeah, it's going to change things. That's why once you get to that point, we're going to have to adjust how we look at the markets. Yeah, for sure. I don't know though. It depends on how much volume is after hours. If people still want to trade during Eastern Daylight Time, because it's still like East Coast dominated, if that starts changing, you have Texas trading because we have a Texas exchange opening up, then yeah, it's things are going to start changing more and more, and we're more international anyway, so it makes sense. Like if a lot of foreigners start to, I mean, we already know, right? I showed you that chart. 40%, 30 to 40% now of the US market is pretty much driven by foreigners, right? Like they own 20-30% of the stocks on the New York Stock Exchange and the Nasdaq. So yeah, so let's see what happens. All right, okay, so this is Rumble. So it had earnings. We started going back up. So this line here I drew around $10 because this was a SPAC. All right, it opened at $10. We keep dancing around it, up and down. I don't know where this is gonna go, and they want to shift to AI. Let's see what's gonna happen. I'm not sold on it yet. Okay, I'm not really sold on it yet, but we'll see. Okay, Lunar. I talked about this already, I think, last time, yesterday, because I said like I liked how it behaved in earnings, because you could see like we went down. All right, we opened lower on the earnings, and then we melted up. And then after that, we started moving up for the rest of the day. Very good. And the next several days, up, 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 right? So that's good. So we have that. So even though it's down 5% today, it still maintains the gap here that it made after earnings on Friday. So last Friday. So that's still bullish. So I think out of all the space exploration stocks, this looks good. LUNR, Intuitive Machines. Okay, we already talked about Wi-Fi. I said like, okay, they're gonna issue more debt. This is gonna go back down. So maybe this one is not going to be something I'm interested in anymore. Shaz, same thing, very new. I'm not sure, right? We got this range over here, you could say. So I don't know. If this can't hold, then forget about it. XTI. All right. We went right up to this level here, right? This pink line. We went right up to 94 and a half. Okay, so are we going to continue on up anytime soon, or do we have to wait for October? If this thing goes back down, then forget about it, right? So after expiration on Friday and then Nvidia next week, we don't know. So this is semiconductor related. So let me summarize it for you. So what does this AXTI do? Okay, engages in design, development, manufacture, and distribution of compound and single element semiconductor substrates. What? All right, so this is more niche. Okay, and we went over some of the fundamentals with that Mark Muldrum Canadian dude. I guess it was like over a month ago. I played some of that video about AXTI. I think this is a good company overall. That's what he pretty much said, right? So we hit the low here. Perfect. Okay, that $39, $40. Okay, yeah, you go a little bit below 40, fine. You bounce up. Okay. All right, let's see. So if this is kind of ugly though, right? If you think this is a range, this is very big range. You go from 140, 150 down to like 40. This is kind of wild. But it's to be expected in this kind of environment. Let's see. Lamentum. Okay, we got earnings. We went up to this top here. 962. We pull back. All right. Let me see. Let me see if I like this one. Because overall, it is trying to make a range, right? We're trying to make some kind of levels here, and eventually this will break out, up or down. I don't know yet, but I'm gonna pay attention to it because I think this is the most stable one out of all the optoelectronics, laser ones here. Okay, AOI, a favorite for trading. You see, we went up to the top blue level, just below this old range, and then we fail. We move back down. Okay, let's see. I'm gonna watch this. And here's another one here, Everpure. So this is a software company. Like I said, I think software is gonna win. So today it was flat, 0%, pretty much. That's fine. With the Nasdaq going down nearly 2%, this is flat. That's bullish. Okay, but the only problem with this one is that we don't know earnings yet. Earnings is August 26th. So I got to wait till next week to figure this one out. But it's one of the strongest looking software companies because of this move right here from July. It's just like $69 and runs up to 117 on what? I don't know. But all right, fine. Everpure. I'm liking this. This is kind of a range that's got built up. August 25th at the bottom, October 25th. So this area here, up, down, up, down, up. All right. So I'm interested. Now I'm interested. Yep. Okay. So I wanted to look for other stocks that are like Air and Teradyne. These semiconductor stocks right here. Okay, so we had earnings here. We went up, we went down, we went up, we went down because of semiconductors, went back up thanks to semiconductors. So this thing has been following the index overall, but But compared to the other semiconductors, right? This thing actually made a new high. Let's look at like something else. Look at SanDisk. Did SanDisk make a new high? Nope. It's still trying to recover what it lost back in June. So I'm just looking for stocks that are actually making new highs. So let's look at AMD. Did AMD make a new high? Nope. This one didn't make a new high. This one's still going sideways. Nvidia, did that make a new high? Nope. Nope. It's still trying to get back to the old high. And it was almost there. And then now today we went down. So nope. We gotta wait for earnings for this one. So there are very few semiconductor stocks that I would say are as strong as this. So you might think like, oh man, it's going sideways. Who cares? Well, look at how it's going sideways. It's actually trying to make new highs. Okay. So I want to look for stocks that are like this. And what does it do? What does it do again? Air Test Systems engages in the design and manufacture, market, and sale of test and burn-in equipment used in the semiconductor industry. Its products include FOX-XP, FOX-NP, FOX-CP, wafer contact, parallel test, and burn-in systems. The WaferPak Full, wafer contractor, and the die pack carrier, and WaferPak aligner, and die pack autoloader. And okay, this is very niche. And I said that this thing followed Tesla for a while because Tesla used this a lot at a certain point. But now it's outperforming Tesla because it actually got into AI and other sectors, so it's no longer tied to Tesla anymore. So the reason why it got stuck in the past several years, so if you look at the monthly chart here, okay, you look at this, I can put in Tesla and you could see like it follows it. So let's put Tesla, new price scale. Look at that. Look at Tesla and look at Air. Air follows Tesla. But recently, Air is outperforming Tesla. So this is the reason I added it to the boomer stock, because I think right now it's diversified itself away from being so dependent on Tesla that it can go higher. Okay. So now I think we are at the point where we can go higher. So you can see that, right? All right. The other one is Teradyne. And this one has done very well since May. Very good. We're doing the sideways thing. Not bad. Today we're down 8%, whatever. I mean, this is very volatile stock, but I probably will add this now to the boomer portfolio. So what does this do? Engages in the development and sale of automatic test systems, just like Air. It operates through the following business segments: semiconductor test, robotics, and all other. Okay. Semiconductor test segments designs, manufactures, and markets semiconductor test products and services. The robotics segment includes operations related to the design, manufacturing, and marketing of collaborative robotic arms, autonomous mobile robots, and advanced robotic control software. All right, good. I think if we're gonna make robots, you're gonna need this one. So yeah, I'm gonna add this one onto it. I think we've already broken through a lot of this resistance. We're holding on here. It's volatile. It's not really like calm. All right, this is not calm. Going between 300 and 485 back and forth. But I think this is going to be a winner overall. Okay, so I wanted to find stocks that are similar to these two, Air and Teradyne. So I asked the AI, give me some stocks that are similar to these. All right, let's see what this one is. ACM Research, ACMR. Okay. Chart looks good. So it's probably similar. So let's see. What does this do? Engages in development, manufacture, and sale of single wafer wet cleaning equipment. It supplies process solutions that semiconductor manufacturers can use in numerous manufacturing steps to remove particles, contaminants, and other random defects. So these guys try to keep the clean room clean. So if you know about the old Intel videos, so if you remember from the 90s, you had those Intel guys dancing in the bunny suits. Yeah, you can't have any dirt in a clean room. So if you manufacture semiconductors at a high level, you can't have a piece of dandruff drop into your chip. You can't have any little piece of dirt off your fingertips going into. So you're going to be in a bunny suit. It's like a hazmat suit, basically. Okay. This thing has to be ultra clean. So these guys are going to work on that. So I see. Very good. I see this is looking good to me. We already broke out of here. So probably a good candidate. Let's look at another one. Excellius Technologies. All right. This one looks kind of volatile. Um, so we made the high here. We're pulling back. Yeah, this looks kind of nasty though. Like, what is this? Okay. We go between $46 and $200. Okay, well, this one kind of looks bad from a risk perspective. So if I'm telling people to buy this for the long term, I'm not sure. Maybe I don't want to pick this one. All right, let's see what this one does. Manufacturer of capital equipment for the semiconductor chip manufacturing industry. It's ion implantation system. Okay, so if you don't know about semiconductor fabrication, ion implantation is when you have the silicon substrate and you have the polysilicon on top, the layer on top, and then you start like zapping it with ions to create different sections of the semiconductor. So a semiconductor would be made like, I don't know if you guys know transistors, so I guess you don't know about bipolar junction transistors or metal oxide. Okay. Yeah, we're not going to talk about that. Let's put it that way. So the ion implantation would mean like it's trying to deprive the piece of silicon of electrons. Okay, so they try to get rid of the electrons or add positrons or whatever. Well, not positrons. I mean, I'm kind of like I don't want to get into a physics lesson here. So let's just say you add a charge to it. So you either add negative charge or positive charge to your thing. Maybe that's the most basic way I could describe it, because I don't want to get into like chemicals, and that means I have to pull out my chemistry books too. Okay, forget about it. Okay, forget about it. So the product line includes high and medium current energy implanters. It also offers post sales equipments. Okay, so it's pretty much manufacturing, right? Semiconductor manufacturing. Um, this, all right. I don't like this, so I'm not really sure if I want to put this on, but I'll watch this regardless. Okay, ICHR. What's this one? Ooh, this one's like, yeah, I don't know. This one doesn't look good either. I don't know if I would. Okay, well, yeah. Okay, what does this do? Let's see. Engages in designing, engineering, manufacturing, fluid delivery, subsea systems. Ooh. Oh, offer gas and chemical delivery. All right. Yeah. Okay. Yeah. Okay. So, all right. I don't know. Looks like it had a happy January up until June, and then it's pulling back. Okay. I don't know. This one kind of looks too wild to me. All right, NVMI. What's this one? Oh, this one looks good. Nice trend. I like this. Very good. From 2010. Very good. All right. Not bad. Looks like we had a recent drop here. 28% in July. Okay. Well, semiconductors did run too far. Maybe this is a good time to buy. Okay, what does this one do? Nova Limited. Let's see what this one does. Metrology solutions for the semiconductor manufacturing industry. Its product portfolio includes dimensional metrology, modeling, and software. Oh my god! Wow. Oh, headquarters in Israel. Oh, it's Israel. All right, definitely I'm gonna buy it then. Of course, I'm gonna buy this one. NVMI. There we go. All right, let's see. Look at another one. Okay, this one has a good trend too. CAMT, Camtech. All right. What is this one about? Here, engages in business and developing manufacturing high-end inception and metrology equipment. Okay, similar to the next one. Oh, Israel. Huh. So Israel has a monopoly on metrology? Well, what? Well. Looks like Israel has a monopoly on something that the semiconductor industry needs. So NVMI and CAMT is now on the top of my list right there. All right, let's look at another one. Kohu. Okay, this one looks ugly. What the heck? All right, so we got this old high here back in 2000. Kind of like Intel, huh? Going sideways for 20 odd years. All right. Well, okay, what does this one do? What does this one do? Engages in provision of back-end semiconductor equipment and services. It offers test and handling capital equipment. Okay, this is very vague. I don't know what this does. San Diego. So I'm not sure. This has been going like nowhere for many years. Volume is increasing though. Okay. I'll keep that on the list anyhow. Form factor. I see. So it had a hard time getting above $44 since 2021. It broke out. Yeah, 33%, up 7. Yeah, well, okay. So this is volatile right here. What does it do? Engages in provision and test and measurement solutions. It operates through a probe cards and systems segments. Probe card segments consist of technologies and product architectures, including micro electromechanical systems technology. Oh, so all right. So this is pretty pretty selective. MEMS technology, basically. That's so micro electronical mechanical is MEMS. So they use that to test the boards. All right. On wafer probing, board tests, and package tests. Livermore, California. Okay, maybe this one might be interesting then. If this is breaking out right now, so you can see like uh, there's niche levels here. We can talk about semiconductors, right? Most people will talk about Nvidia, right? And then they'll talk about ASML for EUV, and that's about it. But now we see there's a lot of these other companies that do specialist, things, services for manufacturing and testing semiconductors. So I think these will be more important. Yep. Literally got some AX. Dude, why did you get it before VIX expiration? Do not do anything when we get to VIX expiration. That's the whole show I did yesterday. I'm like, VIX expiration, VIX expiration. No, don't touch anything as we get closer to options, VIX expiration, options expiration. Something nasty is about to happen. Yes. So that's why we can't do that. That's why we can't do that. With a company like Adobe, their all-time highs are from the era before and during AI coming to market. It's hard to follow that up now because everyone used to AI. Yeah. But you know what? I got this to show you. So apparently, we have this news today. Let's go. Oh-dee-da. All right. Look at this one. Michael Burry updated positions on his Substack. He's long Adobe. I don't know if I should take this stuff seriously, but it's like, oh yeah. See, yeah, I looked at Adobe. I'm thinking like, yeah, Adobe might be good. All right, Michael Burry says Adobe's good. Should I change my mind? I don't know. I guess I'll just keep it. He's also long Lululemon. Yeah, yesterday I was talking about Lululemon and Nike. Nike made a new low on Monday. I was like, maybe Nike looks interesting now. And if Nike looks interesting, let's look at Lululemon. Well, Michael Burry is now long Lululemon. Oh, great. Maybe I'll change my mind. He's also long Fannie Mae and Freddie Mac. I talked about that several times this year, right? Well, he's long that too. Look at what he's short. What is he shorting? Semiconductor, ETF, SOXX, Micron, Nebius. Yeah, I just talked about this today, right? Nvidia, Oracle, Palantir. Oh, man. Caterpillar. Man, I love Caterpillar and Palantir. What are you doing? Oh, boy. I don't know. Very weird. Should I change my mind or what? I don't know. Whatever. I think everyone has their opinion on what they should be short and long in this market. This week we'll have Deere. So if you like farm equipment, maybe let's see what Deere does. So I like Deere. I like Caterpillar. I don't know. Come on, man. And Palantir looks good again. Yeah, now you want to short it? Great. And I'm like, oh man, Lululemon, Adobe. Now you're long that. Freddie Mac. Oh, and Sprouts. I talked about that like yesterday or 2 days ago. Sprouts Farmers Market. I said like, hey, maybe I gotta get long on this one again. Oh, now you're long too. Oh man, I don't know. Fuck. See, I don't know if I should like do the opposite of this guy or not. Um. So, yeah, great, good job, good job. So anyway, yeah, the VIX, that's a problem. Let me see if we got like, did I download the latest video? Did I download that? I don't think I downloaded it. So let me download it. We got to talk about this stuff now. Oh boy, we got to talk about this. All right. Fuck. Hold on. I think we got to talk about it. Yeah. Vol signals. Okay, let me get to this video. So I'm going to download this video, but first, let me play the previous video. So let's see what this dude said last week. Okay, so this will give you some context, I guess. Give you some damn context. Oh my god. Lululemon and Nike. Great. I'm going to be long those two things. I didn't want to be long, but if this guy's long, maybe that's a good idea. Yeah, let's see what happens. All right, so I'm gonna play the old video. All right, let's see if I can find it. This. All right.
This all the weird behavior we've been discussing over the last month could be about to change next week, and here's why. Often, expirations come with supportive flows. In fact, you're probably most familiar with expiration because you've heard people talk about supportive OPEX, Vanna, and charm flows. But the reality is that is not an automatic given. That depends squarely on the position. And if you've been paying attention to our channel the last month, we've been drilling the point that the position is inverted. If the position is inverted, you need to prepare for the opposite of the normal thing. And if the normal thing is usually to drift higher, well, prepare for a more flat or a bit bearish of a week next week as the August positions.
So, okay, so if you look at the Jem Carson videos, the problem we have now is that we have a weird situation where people start going crazy the month before quarterly expiration. So usually the quarter expiration matters, right? So March expiration, June expiration, September expiration. But since COVID-19, we see this weird effect where crap starts happening the month before. So if you look at COVID, Jem Carson's theory was that dude, everybody knew COVID was happening. So COVID was in China starting November. At least it was openly talked about in November. November, everybody knew COVID was around. So why did it take March to crash the market, right? And the thing is well, it's because of the news, because we had lockdowns, blah blah blah. That was the difference. But if COVID was a real big problem and China was already going into lockdown by the time we got to January, why did people think it was not serious, right? So the theory is that the positioning of the options kept the market going up into February. And February was the month before March. So if you look at February to March, we went up all the way to February expiration. So February VIX expiration, February options expiration, both of them pretty much aligned with the top of the market in 2020. So we went up a lot in 2019 towards the end, and we kept going up into February 2020. And then after the expiration, we started going down. And that was kind of before people were talking about lockdowns in the United States. It was already going down. And then by the time we got to the news of the lockdown, okay, we went straight down, right? But it was already going down. So Jem Carson's theory is that it doesn't matter about the news. Who cares about the news? The news is something that explains what happens because people try to look for reasons why something happens. But Jem Carson's idea is it's not really about the news. It's the options, the way it's set up infers what's going to happen. So either you believe that people are setting up for something that's going to happen beforehand, and then when the options expire, that's when it really happens because the options kind of makes things delayed, right? You have a lag or something like that. Or it could just be because of the mechanical way the options work and it forces the market to behave a certain way until it expires, right? Something like that. That's kind of fine with me because I always say forget about the news. The news is too late. By the time you know what the news is that caused that move, everybody knows it. So there's nothing to gain. The reason you make money on the market is because you know something ahead of time before everyone else does. That's the same thing with the oil stuff, right? How come the oil was behaving in a weird way starting at the end of December going to January, and then by the time we got to February, oil stocks started moving up, 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 up. And it's did people know we were going to war with Iran? So, or was it because of options? I don't freaking know, right? I can't really tell. If a trader is trying to make a mental map of when not to trade, is a simple answer. I've been trying to say in this show, anytime we get closer to expirations, get out. Whatever you trade, it's like earnings. So earnings, I don't like to trade that. I try to make my money before we get to earnings and then after earnings. Same thing with options. So the options control the whole market, the total market. So And this is kind of like we're in a weird pattern here because like so yesterday's show, we have this weird behavior here, right? So we have a weird condition. This is the weird condition. This is not normal. The correlation between the VIX and the core 3M are not aligned. The last several times this happened, it was before we had a big VIX move up. And if the VIX moves up, that means like the volatility goes up, right? So we've seen like this dispersion. So if you go back, you have to look at my morning show because I go over this in detail. And this is what like we have to worry about. So it's a bizarre case. So last quarter we saw something weird, right? We saw a lot of volume in May. May is not like the end of the quarter. June is the end of the quarter. How come there was so much volume in May? Nancy Pelosi bought her Intel options in May. The last trading day of May, we had a huge amount of like volume. Weird. Why was May so important? And after that, what happened? When we went to June, what happened? Semiconductors crashed. Korea crashed. Everything started crashing. So, yeah, it wasn't the end of the quarter, right? The end of the quarter is the end of June. How come the beginning of June, something weird happened? So, if you look at Jem Carson's stuff, he's like, what's happening now is that the month before the quarter expiration, shit starts happening. So that's it. So maybe this is the reason why. I don't know, but there you go. All right. I mean, you avoid VIX expiration. No, I mean, we can't. I mean, that's the problem, right? You think like every VIX expiration and OPEX every month. No, not every month is going to be like this. Not every VIX expiration is like this. It's just because of the weird way the market is set up now because of what? The yen, the dollar, Trump, Besant, right? This is not normal. We are not in a normal market. And that's why I keep trying to say it's like, this is why none of this is going to be normal. And in the future, it's probably not going to be normal either. Everything now, what we're learning is as we go. So options market matters more. 24-hour trading is coming up. We have high inflation that's going to stick around. This inflation is not going to go away. We are living in a different world. Okay, so that's the reason I started this show, because I could tell like this is not the normal way things were back in when I was doing the stock market. Back in my day, all you had to do was buy and hold and make money. Very easy. But now, I don't think so. I think now it's like if you buy and hold, well, I think you're a sucker. I think you're going to be a sucker. That's the problem. Inflation is high, so buy and hold, you have to make a lot of gains to overcome the high inflation, right? And now we have all these options screwing up everything. So now you see like, oh, now I care about VIX expiration. Now I care about OPEX. Back then, I only cared about the quarterly OPEX or quarterly VIX expiration. Now I have to worry about the month before the quarterly expiration. What? So now you see the problem, right? Now you see the problem. Everything is screwed up.
Expire. The usual effect we see at expiration comes from the very simple case that most of the world owns stocks. And because they own stocks, they have to buy puts to hedge them, and they sell calls to finance them. This produces something called a skew in the index. As a market maker, you're wearing the other side of this position. We sell the world their puts and we buy the calls from them. When we do this to hedge it, we sell futures. But as we march towards the expiration date of this position, The options become more and more out of the money. Their deltas drop off due to charm or decay, and we have to buy back those futures. This is the origin of much of the index's drift. But again, for this to be true, the position has to be normal. But right now, it's still not normal. And the range that we're contained in is the opposite of what we usually get. Let me show you the position expiring next week and exactly what's different about it here in VS3D, our dealer hedging platform. So this here is the August inventory. You can see here that this is market makers. These expirations are the August AM and the PM positions, the ones expiring next Friday, the big cycle. Now, when you look at this, it might appear pretty noisy, but I want you to focus on the shape here. Remember, dealer shorts, things that customers buy to hedge, these show up on the left-hand side on these orange bars. These are short positions that produce negative gamma, negative vega for the option market maker. On the right-hand side are dealer longs. These are places where customers have sold options to market makers. Oftentimes, these are overwrites. Now, you can normalize positions in VS3D. As you see here, this looks a little bit different. When we show strikes bucketed by 10, this allows some of the shape to show itself. Remember, when options expire, they produce forces by way of the market maker's hedging requirements. When you expire a position as a market maker, short positions create negative gamma and a charm influence that forces us to hedge in a way that pushes the market away from the strike. We talk about this in onboarding all the time. When you have a long position, the long positions create positive gamma. They create what you may have heard of as pinning. The reason is, in either dimension, spot movement or time, all of the hedging behavior redirects the market towards the dealer long. And so when you look at these positions, you're looking for a shape. And the shape is going to be flanked by dealer shorts, creating a range. And inside that range...
So you remember last time I was talking about call walls and put walls? So as we get closer to expiration, these walls get more influential, okay? So the call wall is like a magnet that drags everything towards it. So if you're going up, you're above like the gamma flip level. You're going up, and then you're going towards the call wall. You get, the closer you get to expiration, so this Friday, right? You just get dragged towards it. And then once you get dragged towards it, if you try to go above it, you can't, because you go above it, you go back down. You go above it, you go back down. So that's why you see we're going flat for the last like week and a half to 2 weeks right now, right? We're stuck at the SPY level. So if you look at the S&P 500 or the NASDAQ 100, you see like it's practically going nowhere. So even though we went down today, overall, it's still flat. Like we haven't really moved anywhere, okay, on the index level. So that's what's happening. Now, if we started crashing like we did at the end of March, right? When you get towards the put wall, after the put wall, like you get closer to expiration, you bounce off of it. So when you get towards the put wall, you go towards the lower level. The strength that it pushes up is very strong. So if you go down and then some news happens, like Trump says, hey, we're going to talk to Iran again, and then you have the taco trade, we bounced right off, right? We shot like a rocket. So it's very violent when you go off the put wall from below. So you go bounce off. So it's kind of like the reverse with the magnet analogy. So it's like it's two magnets that are the same pole. They bounce off each other. So that's kind of like how it is. So you have one side where the magnet drags you towards it, and then you have the other side where it repulses you. It like it bounces you off in a strong manner. Okay, as we get closer to options expiration.
An obvious place where the market may settle. And here it can't be more clear once you understand what you're looking for. You have hedges everywhere, right? We've had spot up, vol up territory for the better part of August now. And we've had negative gamma through a good chunk of this range to the upside. And a lot of this position is causing that. What you can see here is that the only real settling place, again, the settling place being where the dealers, the market makers, own options and own gamma locally, is right around 77.5. Now, what's interesting about this, August was very different than the months preceding it, right? If you recall, we had spot up, vol up market behavior in April all the way to the end of May. And then we saw the market snap into a totally different frame, and actually have a serious sell-off in June and another.
Okay, so there we go. So he's saying like from April to May, we were in a regime where the volatility was high, but the market went up, right? We saw semiconductors, Korea. Yeah, we saw that. But after May, all of a sudden it flipped. So we're in August. We're before September. September is the real quarterly expiration. Are we going to see the same thing? Are we going to see the same thing? And yesterday's show, I played the Jem Carson stuff, and he was like, yeah, I've seen this before, where the month before, like February during COVID, before the March drop, this happened, where you went up into February expiration, you dropped into March expiration, and then when you get to March expiration, you bounce violently, go back up. So there's some weird mechanical flow with the options for the month before the quarterly expiration when you have like these extreme news events, right? COVID, Iran, yen carry trade. I don't know. There's some weird effects going on when you have like some anticipation of something going wrong.
Of a swoon in July. And how far did we run after July? Well, interestingly enough, on the morning of July expiration, the August AM straddle was worth $278. If you add that straddle price of $278, the market's expected range at that moment, July, to the market's level at that time, you get 77.48, which ironically, or not so much, is almost exactly where this position would imply settlement. All of the balancing act, dealers pushing away from shorts in this range, pushing down away from shorts in this range, coalesces to the same place. There's consolidation behavior. There's a pinning mechanism that leads us back to right around 77.25 through 77.50 for the August expiration. So if you're expecting more spot up, vol up behavior next week, maybe don't. If you're expecting the market to have supportive charm and Vanna at its back for an easy drift higher into the 78 or 7900s, the position does not compel that. In fact, the positions themselves, as you can see right here, suggest that the range boundary might have just been tested, and the fade makes a lot of sense. The most likely pin for August would be right around 77.5. Now, if you're expecting us to just be off to the races when that expires, remember, these positions create the structure for the entire cycle. And so when this position snaps off and expires, don't expect the same behavior. And so what comes next? Well, if you want to know.
All right. So this was last week. All right. And so this week we see we're stuck, right? We're stuck in this range. Nothing has changed. All right. So let's go to the other video. So this was the video today that was released several hours ago or whatever. So let's get the update. Tell us what to do, Guru. Tell us what to do. What the hell is going on? All right. Here we go.
In the last video, we talked about this week, OPEX week, should see suppressive flows because of the way the positions were structured. And 2 days into the week, that's exactly what we've seen. With a sell-off of 100 points off of the highs, importantly too, multiples of what either straddle implied either day. In this video, I'll walk you through how it is that we can know this ahead of time and how you can see it for yourself. So last week on X, I detailed how the position looks underneath the surface. Importantly, in the expiration, everything's expiring. So options that have delta today are either going to go to 0 delta if they're out of the money or 100 delta if they're in the money. And this sometimes causes dealers or market makers to have to buy or sell a lot of futures this particular week. Most weeks we have what we call supportive charm and Vanna, but this week was different. The positions were inverted this time, which of course means that the hedging around those positions is backwards compared to what you might be used to. In fact, of all the expiration cycles this year, this one was the heaviest implied selling by far. And so when we fade off of 7,800, it's not that suddenly things have changed. In fact, this was all very foreseeable. At least the imbalance that leads to the result is fairly foreseeable. So the structure of the positions as they are is what actually dictates whether the hedging is suppressive, creating a lot of selling flows this week, or supportive, creating the normal buying that people expect. Well, this time the structure was clearly suppressive. where unbalanced market makers are short calls and long futures in this range, and long puts and long futures. This is the opposite of the normal position. And so it's those futures that have to be sold the entire time because the options will no longer be there as of next Monday. And the chart is exactly what you get when you model the positions accurately. You notice here, there's a black bar that reflects what we call charm. The bar is telling you at which point in different spot levels does the market maker position decay positively or negatively. A positively decaying position means that as time passes, the market maker has more positive option delta. They're going to make money if the market goes up. Of course, they have to hedge that. So they don't just leave it, they actually sell futures. So the way to read a chart like this is that in the range where the bar is above the axis, or there's positive delta implied coming to the position on decay, that implies selling. Now, it doesn't mean that we have to go down, but oftentimes, especially at these moments where things become more mechanical than usual, it correlates very well with the range. For example, here, last week, I said the position implies selling between 76.85 and 78.5. And where are we now as I record this? We just made at least a temporary low at 76.93. Again, it's not that this causes the move or that it's the only thing happening. It is a big contributor. The bias is a big contributor. When you think about these systems, think about it as an equilibrium. Most of the time, there's a balance in play, and that's creating the existing market movement. Now, what we have here is a position, the August SPX position, decays in such a way where above 76.85, it implies selling. And quite consequentially, as we sell off towards 76.85, it flips. When you see the bar cross the axis, it flips. And so suddenly, the presence of a large selling flow dissipates rapidly and then turns into buying. And so it's the combination of the two. It's not just that the selling disappears, it actually turns into buying below the level. And so it's not always deterministic, but when they're this large, it's very important to respect what the data implies, because at least this time, it got the range almost perfectly. And the week is not over yet. We still have to expire the August position. So tomorrow, Wednesday, the VIX expires and settles. Volatility might come a little bit unglued. We often see more realized vol in the SPX on VIX expirations. But the big one is Friday. And so Friday, when the SPX expires the August contract, this position will disappear. But right now, this position also tells us something about a range we can expect. And for me, it says between 76.5 or 76.50 in the index and approximately 77.75 is where we should find some balance in trading. Now, it also implies to me that this dip was mechanical, and I would imagine there'd be a little bit of a rebound somewhere in the order of 77.5 into Friday's expiration. Again, this is not necessarily a prediction. It's not me saying this should happen, go trade it. Nothing here is financial advice. This is the mechanical output of a model that prescribes hedging flows, and the levels come from visualizing the path through that prescription. So if you're ever going to pay attention to this data, this week, expiration week, is probably the most important time to at least be aware of these forces so you can factor into your trading. So you might not make the wrong decision if this wrong sides you. So the positions will change throughout the rest of the week, and so too will the implications. So to stay on top of this.
All right. So you get some idea, right? You get some idea. It's like, oh, okay. VIX expiration, you get stuck in some range. You don't know if you're going to go up or down. And then once it expires, you're going to go down or up. I don't know. I don't know. So avoid trading at certain times, but we don't know when those times are. Like, I think the thing is like, I don't really care about like every month's expiration. All right. Not every month matters, but because we're in a weird situation, right? Like this year has been weird. Let's put it that way. You had the oil shock. You have the diesel crack spread shock. You have the semiconductor Korean bubble shock. This is not a normal year for sure. I think any other year I wouldn't care about August expiration. I really wouldn't care about May expiration. Those are not the quarterly expirations I would be worried about. Most people would ignore them completely and go on with their lives to June and September. but because of the strange way we've been doing things so far, thanks to Trump and whatever, yeah, that's not happening. That's not happening. That's not happening. Yeah, so I don't know. Like I said, like the time to buy was back when I said to buy what 3 weeks ago, when we had like the earnings, right? Kevin Warsh, the earnings. That was the time to really buy. Okay, but if I was serious about buying for the long term, no, because I know elections are coming up. That's something to think about. I know the Iran war isn't over with. I see the bond yields are going up, right? There's a lot of, and like yen and dollar, there's trouble there too with the euro. So there's problems. And I don't think I would be buying, like saying, like, oh, yeah, I got the real dip. No, that's probably not the real dip. It's just a tradable dip that you can trade for a few weeks. Best case was a few weeks. I didn't know if it could last more than even 1 week or even 3 days. Hell, I know. But I said, like, well, if you got there, you're comfortable, right? If you got that low. Anything else is just like extra credit. Extra credit. So yeah, that's the problem we have. That's the problem we have. Everything is all screwed up now.
Good morning, everybody. Good morning. I know it's been a while, but I recently went on a trip to California, and now
So this is the normie take.
now I am back. And while I was there, something crazy happened. QQQ just started crashing like crazy. Tech started crashing like couldn't be more thankful. And I finally made my move into the NASDAQ 100. And the whole time the trip in California, I was doing research on the NASDAQ 100 versus the S&P 500. And this is kind of what I found. So if you go back 30 years from now, right, that's 1996. Over that 30-year time, the S&P has returned about 10% a year, and the NASDAQ returned 14% a year. And the NASDAQ's interesting to me, right? Because the NASDAQ is like the leader, it's the future, it's the risk, the gamble, and you get the reward, you know? The S&P 500, you're playing it safe, it's 500 companies, but the NASDAQ is exciting. This may be the dumbest decision I've ever made, or this may be the best decision I've ever made in my entire life. But I'm a young guy, and I'm making it, and I'm dedicated, and I'm telling you, this is what I am doing. This is not financial advice, but I do have my Robinhood link in the description if you want to sign up. We both get a $5 stock, but anyway, it is my opinion that we live in an age that is either going to completely mess us up or completely skyrocket us as a society. Quantum computing, artificial intelligence, robotics. When I was a kid, about 14 years old, we used to always hear about quantum computing. Me and my close friend, we would talk about quantum computing all the time. We were like, dude, one day we will have quantum computing. This is going to change the world. It looks like Google will be the first company to have quantum computing. It looks that way. Obviously, things can change, right? But one of these companies is going to figure this out, and we will get it. And it's going to change the world. And robotics is going to change the world. Elon Musk talks about this all the time. I like Elon Musk, but he's got a lot of flaws. I'm not going to fucking glaze him or anything. But he says the dumbest thing of all time. He always says, listen, don't even worry about investing, because in 10 years, nobody will need it. You won't even need money. Money will be obsolete. Robots will be doing all the work. And I'm like, when have rich people ever lied to us in history? Never. They've always been good. They've always looked out for the poor and middle class. And you know what? We should probably listen to them. Yeah, right. Now, with that being said, Elon Musk is definitely a smart guy. I don't think anybody can debate that. I mean, he might have just lost, 400 billion. And I don't think of him as highly as I did when he was a trillionaire. But there's a reason he stopped producing the Model S and the Model X and started producing Optimus robots, even though we all know they're nowhere near ready. He's getting them ready for adoption. Rich people are going to buy them. People with money, people are going to flex, people are going to use them for views. You already know, like the rich influencers will have like 1 million of them. And it's going to be a giant beta test, because that's the best way to perfect something, is to get them into the hands of people. $25 is a drop in the bucket for like some of these huge streamers and personalities, and it'll be worth it for the content. It'll pay for itself. And for Elon, this will be the world's biggest beta test. Do you really think that these companies are risking all of this money and billions of dollars for no payoff? People may be against robots now, dude, but it's like the example of fast food. I can convince people to love AI and love robots once they always get fresh food at McDonald's and their order is always correct. You guys may think about that and be like, nah, Ian, no way. But you don't understand, like, the average person. The average person doesn't care about politics. They don't care about people's jobs. They just care about their life being simple. And if I tell them, hey, look, we'll just start off by introducing robots into McDonald's and your order will always be hot, fresh, and on time, guess what? People are going to take the robots every single time. Most people will because, you know, people don't care about other people. They may act like they do online, but people, trust me, will gladly pick the robots just to make their life a little more convenient. But this is where all my investments have been going now, I think since May. So I'm up to $1,127 and I have 48 shares of QNDX. This is a little different from QQQ. There's no big difference. The only essential difference is that it's like a little cheaper to own. But I just like it because my monkey brain likes to see like, oh, 48 shares instead of like 2 shares of QQQ, right? I don't know why. I just saw this and I was like, now's my time. I can finally stock them up for cheaper, even though they're essentially the same thing. So this is my plan. I have this set. I'm going to invest in this every single week, every single month. And I am not going to touch this. I'm not going to look at it. Well, that's a lie. I'll probably look at it a lot. Who doesn't bring up their portfolio like 4 or 5 times a day? But I'm not going to touch this reoccurring investment until I am 41 years old. The year is 2036 and I'm 41 years old. And then I will look at this investment. And who knows, because honestly, the NASDAQ technology always leads the way. Railroads, cell phones, internet, AI, quantum, robotics. And if you want a piece of those companies, they're all going to be in the NASDAQ 100. And hey, look, if it doesn't work out, if we're in a bubble and it bursts and I'm just stacking money up, it's going to work out eventually. If it doesn't perform, you can always move out of the position and then put it into VOO or something when I was 41 years old because I'll still have all that money. But in my mind, in my heart, in my soul, I believe in technology. People don't like AI. AI is the devil. It's stealing jobs. Oh well, we got to adapt. AI is a tool. AI is a tool that we have to use, we have to control it, and we have to put it in our arsenal, and we are going to use it to help us make some money, right? We have to use AI because it's not going anywhere. You think the Mag 7 and all these other companies put $800 billion into AI and they're not going to get anything out of that? Do you really think that that's true? I don't think that's true personally, but so I'm rocking with the NASDAQ 100, QQQ. I'm taking some risk. I'm going all in. I am no longer contributing to VOO. It's kind of scary because I've been contributing to VOO since 2023. And that compounding would be really great. But fuck it. My brain works in like an all or nothing way. And we're going balls to the wall. So all in on QQQ. Cheers.
All right. So let's see what the tech spending is right now. All right, you go to QQQ. All right, you like the NASDAQ 100. You don't like the S&P 500. Fine. Why big tech's AI spending is $3 trillion higher than it seems? Massive spending commitments for data center leases and chips aren't shown on companies' balance sheets. Oh, okay. Let's see. Leases not started. $904 billion here. Purchase commitments. $1.52 trillion. Long-term debt. $356 billion. And lease liabilities. $248 billion. All right. You can see that here. All there. Right there. Okay. Massive spending commitments. I don't know. We're spending a lot. Build it and they will come, right? That's the whole mentality we have going on here. Yeah. I mean, that's a big debate. I think most people, they do kind of like split between how much they should put in S&P 500 versus the NASDAQ 100. That's an ongoing debate, because if you want to turn off your brain and want to do everything simple, yeah, you would either do S&P 500 or Nasdaq 100 or a combination of the two, where you like maybe you favor more tech or you favor less tech. That's how you would do it. Okay. I think yesterday's stream I was talking. Well, actually, maybe this morning. Yeah, this morning I was talking about like the technology versus S&P 500, and then I also did. What did I do? Like the discretionary versus the staples. Yeah, so I did some of that analysis for you guys, kind of like going like, well, you could figure out the top, you can figure out the bottoms with this type of thing. But anyhow, I'm gonna end and close with some charts. Not charts. I mean, this articles here. I gotta do these articles for you. All right, let's see. Blah 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 blah. All right, let's see this one. Okay, we got 2 articles. Let's read these 2 articles here. High yield bonds continue to warn of trouble. Okay, this was last week. From McClellan, the daily 80 line for high yield corporate bonds peaked back in February 19th, 2026, and has been in a downward trend since then. Okay, here we go. All right, yeah, we're going down to February 19th. Okay, we've been moving lower and lower. All right, fine. This is bad news for the stock market. FINRA divides corporate bonds into investment grade and high yield. High yield is also known as junk bonds. Okay, so if you know about junk bonds, that's what they call high yield bonds. So anything like 15%, 20%. So the bonds from like companies that are probably going to go bankrupt would be in that category. Based on the agency ratings of each bond insurance. The investment grade bonds tend to trade more like treasury bonds. So they give you lower interest because people know they're not going to go bankrupt, right? If I get a bond from Apple, yeah, maybe 5, 6, 7, 8%. Okay, not much higher than treasury bonds. While the high yield bonds trade more like the stock market. So these are riskier bonds. So if I get bonds from maybe Hertz or Wendy's, something that might be more risky, I might get like 10, 12, 13, 14, 15%. This is important because the high yield bonds are considered low quality investment vehicles. They only tend to do well when liquidity is plentiful and default risk is seen as minimal. When liquidity starts to dry up, the stock market and its major averages may continue to sail on higher, but the high yield bonds start to suffer. This is the warning of liquidity problems, which may come around to bite the stock market. Not all divergences end up in calamity. In October and November 2025, there were small divergences between the high yield bond 80 line and the S&P 500, which ended up getting rehabilitated. A divergence is a condition, not a signal. At the moment, we have a still intact divergence from April to June 2026. And this high yield bond 80 line is still below its 5% trend. These bonds are struggling to keep up with the S&P 500 and not doing well. Here's another chart to illustrate why this is important. All right, here we are. Okay, for most of the period shown in this chart, the high yield 80 line was acting strong and confirming the uptrend in the S&P 500. The COVID crash in 2020 was a notable anomaly where there was no warning from this indicator. Well, I can look at other indicators and find you some warning, but I think we can forgive it for not knowing that the government would panic and shut down the economy. There were some minor dips below the 5% trend along the way, each of which resolved pretty quickly. Things changed starting in late 2021. Oh, what happened then? Well, Jerome Powell said inflation was no longer transitory and he was going to hike up rates in 2022. That's what happened. Okay. A big divergence developed versus the S&P 500. And then by 2022, this high yield bond 80 line was in an ugly downtrend ahead of the bear market, which followed in that year for the stock market. The canary dying in the HY bond market was right about the trouble coming. We have a similar message now, but no signs of trouble yet from the S&P 500. It is possible that whatever is bothering the high yield bond market could resolve itself. That could happen. For now, though, it is saying that there are liquidity problems like ones we have seen before, and this serves as a warning just as we hit the big seasonal weakness due in September. Well, what do we have? What do we have? We have elections for the midterms, right? Going into November. I think that's enough of a worry. I would think that's probably a worry enough. All right, so supply shocks and AI related demand blur inflation signals for the Fed. So back to looking at the supply side and all this stuff. Let's read this article here from PIMCO. PIMCO is a private investing firm in Marina Del Rey, California. So these are pretty big boys here. Recent Federal Reserve communications have turned more hawkish, reflecting concern that persistent supply driven price pressures could begin to feed into inflation expectations. But unlike in prior cycles, today's environment is not defined by supply shocks alone. The forces driving higher costs, geopolitical tension, energy disruption, and strategic investment are coinciding with a surge in AI related spending and wealth effects that are supporting demand in parts of the economy. This combination matters for policy. Traditionally, central banks can look through supply shocks because they weigh on real incomes and demand. Today, however, supply constraints may be interacting with investment and wealth driven demand in ways that blur that signal, raising the risk of misdiagnosing the underlying inflation process. What's more, the demand augmentation from AI could eventually give way to a more deflationary rise in productivity and fall in labor share. So for more, read our May 21st, 2026, macro signpost, AI, market power, and diminishing labor share. Our baseline is that this uncertainty keeps the Fed on hold through 2026, followed by rate cuts in 2027. However, the range of outcomes is widening with a growing risk that policy will need to pivot more abruptly in either direction in 2027. Fed signals openness to rate hikes amid inflationary pressures. Recent Fed communications suggest policymakers are increasingly sensitive to the risk that inflation remains above target. Minutes from April Fed meeting indicate that a majority of participants see further policy firming as appropriate if inflation does not moderate, while a range of Fed officials have since publicly commented that rate hikes can no longer be ruled out. The Fed's hawkish pivot comes as U.S. personal consumption expenditures (PCE) annualized inflation, both headline, which includes food and energy prices, and core measures, has accelerated in recent months to levels more than a percentage point above the Fed's 2% long-term inflation target. All right, read more here. Fed assesses inflation in our May 6, 2026 macro signpost. U.S. inflation measures tell two different stories. The acceleration in PCE data, along with stabilizing labor market momentum, And some moderation in the unemployment rate has lifted the Fed's own Taylor rule estimates of appropriate monetary policy. The range of rules the Fed reports in its semi-annual monetary policy report to Congress suggests the policy rate is 75 to 100 basis points too accommodative. See figure 1. All right, let's see figure 1. Okay, let's see here. Taylor rule, the green. Well, man, they should use better colors than this. What the heck? Oh my God, how am I gonna read this stuff here? Ugh. So this is the Fed funds rate. Yeah. So if we look at here, this dark freaking blue green line here is it below the other two lines above it. Apparently, I guess the other lines went beneath it or whatever. But yeah, so we don't care about inflation, right? Yeah, there we go. That's basically what it says right there. The Taylor rule is a formula with several variations that estimates an appropriate level for policy rate based on economic data. Yeah, you guys can look up the Taylor rule. Stubbornly elevated inflation has coincided with supply shocks, including tariffs and higher energy prices from the Iran conflict. Economic theory and historical evidence suggests that central banks should be cautious about tightening policy aggressively in response to supply-driven price pressures. In other words, that they should look through the inflation data. So this is how it works. They don't care about Iran. They're not going to care about COVID-19. They're not. That's how they work. That's how their mentality. That's why Jerome Powell was like, "Oh, inflation is transitory. COVID-19 lockdowns, blah blah blah. Those are supply shocks. We shouldn't care about them because eventually they'll work their way through the system and normalize. So we shouldn't care about them. That's that's the way they work because they can't control supply side. The Federal Reserve, all they can do is raise interest rates, lower interest rates, control like the bond market a little bit with the QE, so they can control like the long end of the bond market. But outside of that, they can't do much about lockdowns or tariffs or wars in the Strait of Hormuz. They can't do any of that. So all they can do is ignore it. So they would think like, oh, it'll resolve itself and long term, doesn't matter. Over the long term, it'll fix itself. That's the whole point. This tendency likely explains the current gap between policy rules, such as the Taylor rule, and actual policy. However, other trends in the U.S. economy, with its large-scale tech and energy sectors, complicate the inflation outlook. We may see supply shock contributing to, or at least coinciding with stronger demand in certain sectors. For example, geopolitical tensions may be driving greater urgency to invest in AI in an effort to boost efficiency and scalability, lower labor costs, and support national security. Furthermore, if global energy prices stay elevated, eventually U.S. energy investment will likely rise too. Just how strong these demand side impulses will be against what for most households and non-energy businesses is a real income squeeze due to higher prices is a key question for the Fed and other policymakers. Read more in our April 22nd, 2026 macro signpost. Higher energy costs, weaker tax relief squeeze U.S. households. Which part of the K-shaped economic trends will dominate is uncertain, leaving central bankers open to a wider distribution of possible rate outcomes. So the K-shaped economy, people have been talking about that for a while now. There's going to be like the wealthy have a different world, live in a different world than like the bottom part of the economy. Okay, especially when it comes to inflation. Supply shocks and optimal policy. Taking a step back, questions around how monetary policy should respond to supply shocks is not new. While monetary policy rules would prescribe hikes in the face of supply induced inflation, both economic theory and historical evidence suggest that central banks should be cautious about tightening aggressively in response to supply driven price pressures. When inflation is driven by excess demand, higher inflation can help bring inflation down while also slowing the economy, um, which helps stabilize both sides of the Fed's dual mandate: price stability and maximum employment. Supply shocks present a fundamentally different trade off. When inflation is driven by a negative supply shock, which is such as an increase in energy prices or a disruption in global supply chains, prices rise even as output weakens. In this case, tighter monetary policy can help cool demand, but it also risks amplifying the growth slowdown and raising unemployment without directly addressing underlying source of inflation. So that's why the Fed, is afraid, right? If they start raising interest rates too aggressively or they hold interest rates too high for too long, it might not matter anyway. It doesn't affect inflation because if it's a supply causal reason, it's not going to help. So I feel like we are entering a world where inflation stays high because the Fed probably will be too afraid to try to make the demand side go down. If they do make the demand side go down, all that does is make people get pissed off. Okay? It's not going to solve inflation really because most of the causes of inflation on the supply side won't be affected. And if we are going to enter into a big El Nino season, guess what? I don't know what that's going to do to the crops, right? Coffee, sugar, wheat, soybeans, corn, um, those things might rise anyway. The Federal Reserve can't control the weather. Now, don't get me started on conspiracy theories, okay? I don't want to get into that with you guys. I'm not going to talk about HARP. I'm not going to talk about weather modification. I'm not going to talk about that. But I feel like one of the things I talked about before is that we should go long in corn, soybean, wheat, because I feel like we are on an uptrend on grains. So, alongside fertilizer, probably. So, we'll see. This asymmetry is embedded in monetary policy frameworks. Under flexible inflation targeting strategies, central banks leave themselves room to look through temporary increases in inflation, particularly when inflation expectations remain well anchored, while focusing their policy response on more persistent demand driven pressures. Monetary policy works through long and variable lags. So, responding too aggressively to temporary supply driven inflation spikes can cause unnecessary volatility in future output and employment. Beyond the frameworks, many central banks historically have followed this approach in practice as well. According to a BIS study over recent decades, central banks in advanced economies, and the Fed in particular, have systematically responded more forcefully to demand driven inflation than to supply driven inflation. Looking through has limits. So here's the problem. A strategy of looking through supply shocks is not without limits. For one, sustained above target inflation, regardless of its origin, could lead to a de-anchoring of inflation expectations. If households and firms begin to expect higher inflation to persist, price and wage setting behavior can adjust in ways that make inflation more entrenched. So I think this is what's going to happen. The Fed is too chicken to do anything. I think Kevin Warsh is going to be like, I want to support AI. I don't want to stem the growth potential of AI. And I think like if he's a technocrat, he believes that AI eventually will cut down inflation, okay? Because it will lower certain like labor costs or whatever. Let's see if that's true. Now, if that's not true, things are going to get a lot worse. We are going to have persistent inflation because if people expect inflation to stay high, then they will spend accordingly. They will uh, give wages to their employees based off of that too. So if I'm an employer and I'm going like, well, I got to compete with other companies, and if those guys are going to have higher wages because people can't live in a freakishly expensive place like San Francisco, then yeah, I that's going to create more inflation because in the inflation expectation begets more inflation. So wage setting behavior can adjust in ways that make inflation more entrenched and harder to reverse. A self stoking cycle. In such cases, a more aggressive policy response may ultimately be required, even if the initial shock was supply driven. Currently, U.S. inflation expectations across consumers, professional forecasters, and the market appear well anchored. Measures within the University of Michigan survey have accelerated recently, but changes in the survey methodology make it more difficult to interpret that survey in the context of historical data. Other surveys, including the New York Fed survey, the Livingston survey, and the survey of professional forecasters, all indicate U.S. inflation expectations remain well contained. Another challenge, however, is calculating in real time the degree to which above target inflation is related to supply versus demand factors, especially when both supply and demand shocks coincide or supply shocks induce stronger demand for investment. Okay, so we got this. Let's see here. Implications. All right, almost done. All right, let's go here. Decomposing today's inflation into supply and demand. What is the dominant driver of inflation today? Supply or demand? Research by San Francisco Fed economist Adam Shapiro finds that supply has been an important driver of both headline and core inflation since October 2025, when core PCE inflation started to accelerate. But other more puzzling factors are also at play. His research, which is based on the correlation between unexpected price changes and consumers' real purchases of goods and services, finds that supply accounts for roughly 20 basis points of the 40 basis point to 80 basis point acceleration in annualized core and headline PCE inflation, respectively. What accounts for the rest of the acceleration is what he labels ambiguous, i.e., the correlation between inflation surprises and changes in real consumption isn't strong enough statistically to say one way or the other. Okay, let's look at figure 2. How this ambiguous component evolves may dictate how the central bank needs to respond. All right, what the heck is ambiguous? This green stuff here. So we got the supply side, that's the maroon color, demand side, the dark blue, and then the green ambiguous. Okay. All right. So you see COVID-19, 2021, 2022, and then Russia, Ukraine. Yeah, okay. Yeah, supply side dominates. And then now we're like kind of like even keel between demand and supply, but then we have this green ambiguous. So I don't know what that. So what is it? Is supply dominant? Is demand dominant? Well, what is that green stuff? Implications for monetary policy. Supply shocks are clearly contributing to elevated U.S. inflation, but they are not operating in isolation. Parts of the economy, particularly those tied to AI investment and equity driven wealth, so stock market wealth, capital gains, continue to generate pockets of demand resilience, even as higher energy costs and tariffs weigh on real incomes more broadly. Well, okay, how much of the economy is actually, you know, full of people that have houses, stocks, bonds, or whatever? Probably not much. So, I mean, outside of like me and a few other people around me, it was like, well, I like. I think if you look at the younger generation, they're probably not going to have that, right? So the potential for realized productivity gains from AI to eventually be more deflationary is yet another layer of complexity. This interaction complicates policy in two ways. First, it makes it harder to cleanly decompose inflation into supply and demand drivers in real time. Second, it raises the risk that monetary policy responds to the wrong signal, tightening into a supply driven slowdown or easing into a demand driven reacceleration. For now, well anchored inflation expectations give the Fed scope to remain patient, supporting our expectation that policy stays on hold through 2026. However, as long as inflation remains above target and its drivers remain ambiguous, the Fed and markets are likely to face a wider than usual distribution of policy outcomes. That's not good. The market does not like surprises. Okay. So if people don't know what the heck is going on, like how they should fight inflation from here on out, that's not going to help. That's really not going to help. Okay. So let's see. I have this little article here. I'm not going to read it today. I'm going to close off with this, but I might as well read a little bit of it, though. So this is from the Wall Street Journal. The jobless boom has arrived. The stock market thinks the economy is accelerating. Don't expect jobs to follow. Greg Ip. Okay. Patrick Collinson, chief executive of digital payments company Stripe, recently polled his 1.5 million followers on X about their economic outlook. Some 13,000 took the survey. On average, they expect economic growth to double over the next 5 years to an average of 4.3% and employment to fall by around 8%. Think of this as the AI optimist scenario in which AI vastly increases economic output while making tens of millions of workers redundant. The odds of this forecast coming true are close to nil. Employment almost never collapses by that much and never when output is skyrocketing. But the magnitudes aren't what matters, it's the direction. And if a jobless boom once seemed far fetched, it no longer does because we seem to be in one right now. Okay, well, I guess that's the future, right? That's what we got to worry about. And how does that affect supply, demand? I don't know. That's something the economists have to figure out. And if they can't figure it out, then we don't know where we should put our interest rate policies, right, for the Fed. We don't know where we're going to go, how we're going to do it. Monetary, fiscal. That's the problem. All right. It's about 2 hours. I think I covered enough today. Tomorrow will be VIX expiration. The market will probably go down in the morning. The question is it going to bounce and go up towards Friday? Or are we just going to keep going down, down, down into Friday and then into Monday? Because the market doesn't want to do anything until NVIDIA earnings. NVIDIA earnings is Wednesday afternoon, I think. I think it's usually Wednesday afternoon. So that's a lot of trading days. We could go down into Monday, maybe bounce on Monday, or maybe do nothing into Tuesday, get stuck there, and then we have to wait for NVIDIA to help us on Thursday, basically, because Wednesday afternoon is after the market closes. All right. So that's what I'm looking for. I'm looking for that. See if there's a dip. Maybe I'll buy something, and that's it. Isn't OPEX on Friday? Yeah, OPEX is on Friday. but there's no big earnings this week. So what's the news that will make it do anything? Once you get through OPEX Friday, you go to Monday. Usually the Monday after OPEX, you keep going down. Okay, so if we're going down into Friday, we're going to go down into Monday. And then Monday morning will be the low. And they'll be like, well, okay, what's going to happen after Monday afternoon? Nothing, because we have to wait for NVIDIA after Wednesday close, right? And that means we have to wait for Thursday next week. So there's no big on, right? There's only like Walmart. Tomorrow will be TJ Maxx and Target. I don't know if TJ Maxx and Target will matter, but okay, let's see if TJ Maxx and Target do anything. But yeah, that's it. Walmart will be Thursday. And after that, nothing until NVIDIA on Wednesday. That's it. And I think most of it's going to be driven by NVIDIA anyway. I don't think Walmart or any of that stuff. So VIX is tomorrow. That's correct. OPEX is Friday. Yep, that's right. And then we're going to Monday. The Monday after OPEX, probably bad, because if we're going down anyway, it's just going to continue on into Monday. Usually Monday will go down from whatever happens on Friday. So if Friday is bad, then Monday morning will be ultra bad. Whether there's news or not, I don't know. The news, if it comes, will make it worse or make it slightly better. But yeah, we're already moving down anyway. Like yesterday, right? Yesterday, I saw it pre-market. I was like, what the hell? It's already going down. It's not even waiting until VIX expiration. We're already going down. Oh, well, there we go. Bye-bye. Guess we're going down. And we'll see if I buy the dip. Buy the dip. SanDisk, gold miners. I don't know if I want to buy that stuff. But yeah, the major move was already done 2 weeks ago. You got 2 weeks ago, you bought the dip. You already sold last week or yesterday. And that was it. That's all you could do. Now we got VIX expiration, OPEX, and then we're going down anyhow. So yeah. You watched the video this morning and yesterday to get the full picture. Things are gonna get weirder and weirder as we go along. Yeah. That's it. That's it. Okay. But I have to look at the software stuff. So I have some like huge list of software stocks I still have to go through. It's not just Adobe and all that. I have to look at more stuff. Oh man, I still gotta figure this out. Which of these are gonna be the winners, right? So let's see. Yeah, I have all these lists here. So I got a huge list I have to go through. I don't know, but yeah, I think software is going to be the big deal. And we have like some Chinese stocks to like report earnings this week. So Alibaba will be the important one, and then I'll have to see if that affects anything. And figure out if I have to buy like I'll tell you guys to buy the leverage ETFs, right? And KC is like my favorite. KC is my favorite. I don't know if I like anything else except KC really. Do I want to buy Tencent? I don't know. So yeah, we also have like these like industrial stocks to look at. It'd be like, oh, okay, well, Equinor, Bloom Energy, yeah, that used to be good. Arc Best, I talked about like yesterday, right? Yeah, and we'll have to see if this chemical one, the CF, I might have to toss that out, and then we have like the pipeline ET, yeah, we have like the natural gas terminal LNG, we have railroads CSX. GE Aerospace, I talked about this morning. We already have JB Hunt. I don't think we need that one, right? We already have that one. Union Pacific. So yeah, there's definitely like areas that are still doing well. The refinery stocks are probably gonna keep going up, And then we have like the big oil and gas companies like Exxon and Chevron, which have recovered, and I guess will continue on going up from here on out. Maybe, I don't know, maybe not. That's kind of like I'm kind of wondering how much we want to keep adding to it, because if you have Chevron and Exxon from the Boomer portfolio, then you already have those two stocks. And I don't know how much I want to overload it with other ones. We already have Marathon Petroleum. We already have like Phillips 66. So I think that those are fine. Those are fine picks already. I'm just trying to find software companies to replace the losers right now. And I have to figure out if uranium and lithium are going to be worthwhile to get into right now, because I could see like they're trying to make a bottom, uranium and lithium. So those are the other areas we want to look at. And I want to replace like some of the Alcoa with other aluminum stocks and other steel, titanium stocks as well. So that's going to be the next item up. All right. That's what we're going to be looking at. So software, some industrials like you see here on this list. We covered that this morning, and we did more today. All right. And probably yesterday too. So I did some yesterday. I did some today right now with you guys. In the morning, I talked about like the 3D stupid option expiration, all that BS. I don't know if we need it, but I think in the future, if options keep interfering with how you look at stuff, it's going to become more and more important. I can't ignore it anymore, right? Because like, hey, VIX expiration. Which VIX expiration do I care about? Usually I don't care about it. But 2 times this year, the May expiration, it mattered. And now again, maybe the August expiration matters. I don't know yet, but if the August expiration does matter, we will see the market start going down, 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 starting next week. So if Nvidia doesn't come through, if Jackson Hole, Kevin Warsh starts speaking, doesn't come through, we're just going to keep going down into September, and that's it. But if it doesn't happen, we go up, then all right. Then the top will be somewhere in September 11th. Okay? That's how it's going to be. All right. Good night, folks. Good night. We'll see you tomorrow. If something exciting really does happen where we drop tomorrow and then we don't bounce and we keep going lower, okay, I'll come tomorrow morning. I'll just show up and be like, oh, well, look at that. That's strange. We're just going to keep going lower? Wow. Well, so the VIX was important. All right. See you guys.